Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Was it social media? Was it the bond market? Was it Jamie Dimon going on Fox News? Whatever the cause, US President Donald Trump has rode back on his tariff plans, which mean that on today's show, we're once again discussing the fallout from a presidential announcement the night before. It's been a week of extraordinary volatility, but things have hopefully taken a turn for the better now that Trump has revealed the sweeping tariff regime he unveiled at the start of the month will largely be put on pause for 90 days to encourage trade negotiations. That sent the S&P up almost 10% yesterday, but things aren't exactly back to normal, not least because Trump raised tariffs on Chinese goods once again last night, and they're now at 125%. Julian Hoffman and Mark Robinson are here to discuss all the fallout and why we're not out of the woods yet. Then our personal finance editor, Val Cipriani, will talk us through the world beyond the stock market, perhaps an enticing prospect to many after what we've seen lately. But these aren't risk-free assets. Rather, they are unlisted companies we'll be talking about. We'll discuss how the average person can access them, the tricky business of valuing these shares or unlisted shares, if you want to use that term, and whether you can trust those valuations as well. To conclude, we travel all the way down to the bottom of the cap scale and look at results this week from AIM Tiddler Staffline, which has been very much bucking the trend in the recruitment market this year. Valeria Martinez is with us to discuss that. There's clearly only one place to start, though. A quick recap. For those living under a rock for the past week, markets fell more or less 10% at the end of last week after Trump's tariff plans were announced. There was no U-turn over the weekend. On Monday, a fake headline on the wires and social media about a 90-day pause briefly sent shares shooting higher. The White House denied that, but perhaps the market reaction got them thinking about the merits of such a move. On Tuesday evening, there were signs of stress in the bond market. On Wednesday, the recession warnings increased, including from JP Morgan Chase CEO Jamie Dimon, who went on the president's favorite TV channel to urge restraint. Then the climb down arrived last night. Julian, where are we now? What do you make of it all?
Okay, so we're on Thursday, so it might change again by tomorrow, but essentially the pause that we've seen is I think a reaction to a combination of everything you just said, really. It's a sense that the policy hadn't really been thought through, no surprise there. But it has obviously started to alarm quite significantly a lot of people around President Trump, who had previously been relatively supportive or at least passive in the face of the tariff threat. So we had, as you say, Dimon going on Fox. It's actually quite a good way of getting to speak to Trump because he does apparently watch television. He's the last of the kind of baby boomer TV watchers. So that message might have gotten through via that medium. But there were also talk of his Commerce Secretary called Besant going to see him and having what diplomats call a frank exchange of views. And threatening to resign, apparently, according to Fox News. So, yes, it's the situation then developed to the point where markets were throwing their toys out of the pram in the bond market. Treasuries peaking above 4.5% for 30-year and at one point for 10-year treasuries, and that was, I think, the most definitive sign that people were losing confidence in. In a sense, it's not just a question of being afraid of a tariff regime. It's the economic trust that people put in the American government, and if there were signs that was starting to fade very rapidly, it was definitely the bond market that was telling you that. And the fact, I think, remains that a lot of the countries that may have been targeted by the tariffs in the interim, people like places like Japan are massive holders of US treasuries, so they would only need to start selling down some of their trillion holding in order to significantly push up the interest rate. So yes, it is only a pause. I think it's fair to say that the 125% tariffs on China are still the most substantive element that remains in place, and that is to the detriment of quite a lot of American companies who, like Apple, for example, who assemble their goods in China and ship them to the US. And there's no sign yet that is being dropped. So we are, in a sense, better than 3 days ago, maybe. But I think personally that the relief rally we've seen in the stock market is not sustainable, particularly if you sort of measure this against previous crises. People have always been caught out by sudden changes in sentiment, but it's that constant. It's the idea that trust now is gone, which I think is the more significant development, really.
Indeed. There's the China tariff. China's tariffing US imports itself currently at 84%. I mean, who knows if that will rise again on the back of the US increase overnight. We should state that all other countries, other than Mexico and Canada, are at the 10% base level that the UK found itself at last week, while the 90-day pause takes place. So we're not back to square one there either. There are still sectoral tariffs, which we'll get to in a minute. Perhaps if you look at just at China, in fact, and that increase, given how much US imports come from China, we're not actually that different on a trade-weighted basis to where we were even 2 days ago. But maybe, Julian, I can ask you about the reason for some of this rally might be because it's reassuring in a way that Trump is still susceptible to market pressure, as many had originally hoped with tariffs. So there's going to be a sense that other climb downs might happen. Clearly, we've been here before and people have got burned very badly over the past few weeks thinking that. But that may be it's clearly part of the reason for the rally, but maybe a big reason for it, rather than people thinking, well, this is where we are now. They're thinking, well, he is able to respond to some of that pressure in some way.
I guess, and also I guess the pressure that quite a few of his donors in the Republican Party were watching their fortunes disappear overnight, which may have focused a few minds as well in the political space. I mean, he hasn't. The problem, I think, with that argument that, okay, well, he's probably open to reason, is that we don't know whether this is just a temporary thing or next week it's going to change again. If there is one constant with the Trump and this tariff debate, is that there is no constant to it, other than he has said for many decades that he wants to introduce a kind of tariff war to the US. Changes in the market, they have got him wrong consistently. I think that's the thing that I always caution, which always gives me a pause for thought, is that everybody has underestimated what his ability to act. The way that he makes decisions is very, very ad hoc and very susceptible to whatever the mood is at that point. Or whatever his mood is at that point. And I think it's too early to say that this presages some kind of stability of policy. So I think there's going to be loads more gyrations before any of this is in any sense settled. But I mean, there is also this thing that he does step down in the face of people standing up to him, which is quite an interesting observation as well. Like the Canadians and the Chinese themselves did not take anything lying down from the administration, and they tended to back off quite quickly.
Yeah, there's all this kind of COD psychology going on, isn't there, with regards to what to do when dealing with a bully and stand up to him and all these things. And it certainly seems that he does like in some ways to have that sense of uncertainty in being the one to change markets on a whim. But I'm engaging in that psychology myself now, so we should move on. Let's talk about the sectoral tariffs, because that's one area where we're clearly not out of the woods. The automakers tariff is still there, which is a problem for the UK. Trump also said this week that pharmaceuticals, which were spared last week, he said there would be a major tariff coming there, which sent the likes of AstraZeneca down and GSK quite a bit the other day. Clearly, as far as we're aware, that still seems to be on the cards as well. So it's another example of how this uncertainty is going to persist for some time yet.
I mean, I was reading this morning actually that the automakers tariff is particularly going to hit the city of Coventry, which I would say has suffered enough in its history of the last 70 years. But yes, the pharma tariff is an interesting one. They had what looked like a temporary reprieve, but there's clearly in the sights now in terms of having some kind of special rate. Nobody knows what this is or what they think it might be. The only saving grace of in all that debate about pharma tariffs is that a lot of manufacturing is already done anyway in the US for the US market. There's a comparatively, the amount of drugs shipped physically is mainly out of Ireland, but not huge in the greater scheme of the US market. And there is a reverse effect as well. Like tariffs come one way from the US, but what's also happening is that European companies are picking up US pharmaceutical scientists at a massive rate. So there are signs that the tariff regime for pharmaceuticals is causing a brain drain in the US, where whole programs have been shut down, and this has allowed European agencies to set up grant schemes for US scientists, and apparently the demand for that is massive. So you could say there might even be a net benefit if the European industry ends up with a much enhanced intellectual capital position than it did before the tariffs debate started, which would be actually a reversal of what traditionally happened. I mean, all the best scientists tended to go to the US from Europe post-war. So yeah, we all might have to learn chemistry German again, which was a thing before 1945.
Wow. I hope I don't have to do that. It is interesting, pharmaceuticals as well, isn't it? Because this has been a sector which politically there's been a lot of lobbying, a lot of stress even prior to the tariff regime, in terms of a lot of companies upset with Europe and the UK basically not allowing them to earn as much money as they do in the US. So they are quite keen in some ways, I would think, to move more production to the US. At the same time, moving production takes a very long time, which is part of the problem with this whole idea of reshoring, in that you can't encourage companies to make a multi-year decision overnight, and it won't happen overnight. So,
well, it took 7 years before this government to get a factory licensed in the US. So you could build it, and then it would have to go through years of testing and accreditation by the FDA before it was allowed to come on stream. And the FDA has just fired all its staff. So whether that is possible in reality is open to debate, I think.
And what do we think about the UK situation? I mean, pharma is part of that, as I said, but the automakers, the UK government is now reportedly focusing its efforts on lowering the 25% automakers tariff for the UK. I don't know what odds of success we give us. I mean, based on the strategy we were talking about just now, ours has very much not been to stand up and take a stern tone. It's been to try and prioritize the special relationship and see if that works, which it hasn't so far, but maybe they think they'll have more luck when it comes to the car makers.
I mean, I guess anything is possible at this point. Again, we might be straying into COD psychology, trying to work out what approach is the best. I mean, Trump obviously wants to keep his date with the king.
That is true.
I don't know if it's consequential enough to make a difference. I mean, whether the tariff is 10% or 25%, it's still quite a massive imposition. So unless there is some sort of relief or a workaround that they can figure out, nothing is good news on that front, I don't think, which is why the government is signaling that it is going to support that industry as much as it can, which has been particularly vulnerable.
I think there's a certain irony in there, though, isn't there? Because the imposition of tariffs, whether it be 10%, 25%, it doesn't bear comparison with the mandated transition that the government's brought to bear on the car industry already. As we move towards net zero, few people seem to have made that connection.
They're putting that back, though, aren't they? There's going to be a 5-year extension.
Well, a kind of a moratorium on it, but I mean, they're still moving ahead. We've already seen a couple of casualties in this regard, but I mean, it's a little bit ironic, I think, that the UK government is signaling their support for the industry when they've done anything but that in recent years.
Yeah, pray for Coventry, in other words.
Exactly.
Well, let's talk about correlations and different assets, because that's another aspect of the stress we've seen over the past week. Mark, I think you've been looking at this because we talked about the pressure on the bond market. Normally, in an orderly sell-off, you'd expect when equities are going down bonds would rise, and that wasn't quite the case in the past few days. But there's a couple of things you've been looking at in this regard.
Yeah, I mean that correlation has sort of broken down of late, and in fact, it has over the last couple of years, even when Liz Truss had her moment in the sun. I was speaking to a friend of mine. He's a retired fund manager, and he pointed out, because I asked him why is the gold price sort of dipped? This seems counterintuitive given what everything else that was happening in the market. And he it's quite simply explained to me, when you get these major market movements downward, eventually you're going to start getting calls for redemptions, margin calls, and at that point, a fund manager might actually look at the bond markets to get some relief. But because the yields there had spiked, there didn't appear to be any real safe haven. And so fund managers that are reluctant to sell positions in stocks that they consider to be good but have just been part of the general markdown reverted to their gold-backed securities. This happens all the time, apparently, and that's why the gold price went off. I might add one thing as well. I got some interesting data through from Hargreaves Lansdown this week as well, and there appears to be a real dichotomy between institutional investors and retail investors. According to Hargreaves, retail investors have been buying in quite heavily since the market turbulence started, which suggests that they're taking a contrarian viewpoint on what's happened. Of course, I guess with institutions, their positions are automated to a certain degree as well. But I just found that interesting. It'd be interesting to hear, what our readers think about this, or if they've been increasing exposure in equities as a result of the turmoil.
Yeah, that did seem to be backed up by data from other platforms we've seen as well. I think AJ Bell, Interactive Investor. What they've all said, I think, is the buys outnumbered sells. They never reveal the amount detailed in these buys or sells, but I think it makes sense in the context of when you consider the past, 15 years, if not longer, people have been told and taught to buy the dip, and that has worked on every occasion. So people will continue to do that, and probably until it doesn't work. It's too soon to say, of course, what will actually happen here. And I think that's a fair point on gold as well. I mean, we definitely saw that in the bond market too, when you consider, I think, Japanese government bonds and gilts selling off a bit as well. It did seem like it was a bit of a call for liquidity in some cases, probably some other factors in some of those areas too, but we should probably move on for today. I'm sure we will be discussing this for many weeks to come. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. For now, though, we're going to turn to our big read of the week. It is on unlisted assets. Val, why don't we start with the basics? Because, as the name implies, these are not companies that trade on the stock market. How can investors get exposure?
Yeah, so it's via investment trusts. So there's obviously a range of investment trusts investing in then unlisted assets, and the ones we were looking at is private equity and growth capital investment trusts, with growth capital sort of basically being a subset of private equity, but on the racier side of things, so just quite early stage, often, capital hungry unlisted companies.
And what about there are lots of things to go into here as you go into in the piece. What do investors, though, have to watch for here? Because on the one hand, these are very interesting companies, and it might be intriguing to get access to them, thinking previously they haven't been able to, thinking perhaps, as a lot of people say nowadays, a lot more companies are staying private. You really get access to them in that big early growth phase, so there's a lot of potential for growth there. At the same time, there's been a lot of concern, particularly over the last couple of years, about the way these companies are valued, and that would seem to be a key concern that investors have to try and familiarize themselves with as best they can.
Yeah, absolutely. It's a bit tricky because obviously the basic problem here is that when you're investing in a listed company, you get a live price and you can buy or sell at that price at any point. And with unlisted companies, you can't quite do that, or at least the managers who handle these trusts cannot do that. So there isn't really a 100% accurate way of valuing these companies, just because until something is actually sold, is actually put in the market, there is just no way of telling eventually what people will be willing to pay for that. So that is the sort of problem with trusting valuations, that however, it's just the nature of the assets to an extent. There is not a way to value them, on a daily basis. So you kind of have to do a bit of guesswork on that front. And then it gets quite complicated because there are a lot of processes behind the way this works. And especially for growth capital businesses that are a bit more early stage. So some of them may not be generating any profits yet. So they have to kind of like look at things like funding rounds, particularly, and so then it can get a bit tricky. So for private investors, I think the key is trying to understand how it works and being well aware of the risks and the potential, volatility of these valuations, and then sort of take it from there, basically.
In the piece, we talk about a number of the interesting private companies out there and how people can get access to them, and that we won't go into the details of those now, but there's also, I suppose, a context to be aware of there, which is, as you say, these are part of investment trusts, so you're not buying just that company, albeit in some cases, I'm thinking maybe 3i and its stake in Action, so I have mentioned one now. You are in some ways effectively just buying Action at the moment if you're buying 3i, but that's the other thing to consider, isn't it? That you're buying a wider portfolio here rather than one company. But why don't we talk about the funding rounds in a bit more detail, because that's the interesting part for me, looking back at the last few years, because you see examples of companies in the good times, they get a funding round, they grow, and then they have another funding round at a much higher valuation. It goes up and up and up, and people might wonder how accurate that valuation is. But there are ways you can look at some of these rounds, and some of these funding rounds should perhaps be treated with more skepticism than others.
Yeah, exactly. So I think you have to, because usually when funding rounds are covered, you will see a headline that goes, okay, this company achieved the valuation of however many billions in a funding round. But then if you think about how that is presumably calculated, things start to make a bit more sense. So what is happening, is that company is trying to either raise more money or, give a chance to someone to sell their stakes in that company. And then for those stakes, or for that new money, they have achieved a certain price. And then the whole company gets revalued based on that certain price. Now, what is happening is that not the whole company is being sold, obviously. So a lot is about the size of the funding round. So for quite small ones, you have to be a little more skeptical, because there may be demand for a few shares or stakes in the company, but it doesn't mean that the whole company could be sold at the same price. And then another interesting consideration is the difference between taking part in a new funding round and selling an existing stake in a company, which is kind of a little tricky for managers, because when a funding round happens, they obviously have to take it into account when they're valuing their own stake in that company. And it's very important because it's one of the few transactions that actually effectively happen in the market relating to private companies. So, it has to be taken into account. But equally at the same time, they have existing stakes. They're not investing in new money. So it's kind of tricky to find the balance there, because there may not be a secondary market for those stakes.
And sometimes you talked about when funding rounds can be very small, but to me, sometimes even when they're big funding rounds, if it's led by the main investor in the company, that's also an issue, isn't it? Because they are incentivized to provide more capital at a good valuation, because then they can just mark up the value on their own books. That said, going from one kind of cynicism perhaps to another, it's interesting that institutional investors have increased their exposure to private assets quite a lot over the last few years. And one of the reasons, I think, is for times like these we're seeing at the moment, because although private assets are economically sensitive because they tend to be early stage businesses, and you have seen a lot of listed private asset owners, private equity funds in the US sell off particularly badly in the last week because if recession risk increases, it's going to be tougher for those companies. The actual assets they own, as you said, are not marked to market. So if you're an institutional investor and you have 20% of your portfolio, which is quite a high amount in private assets, you see the 80% of the listed portfolio go way down 1 week. That 20% will pretty much stay as it is. It will have to be revalued later on, but who knows, by then markets may have recovered. In the meantime, you get a bit of ballast for your portfolio, really, which is, again, a slightly cynical way of looking at it because these assets, there's no reason their values shouldn't change in line with the market over the long term. But in the short term, it means you don't have to take that markdown. And I think that's one of the reasons why institutions, and who knows, maybe private investors too, might value those. It's a bit harder for private investors, though, because, of course, they have to access, as we said, via investment trusts, and the value of those will go down. So you can't really get that same benefit of pure non-mark-to-market. Let's talk, though, about a couple of examples in the piece, because there are a lot of these trusts out there, be they private equity, be they growth capital. A couple highlighted in the piece, Molten Ventures and Augmentum.
Yeah, there are two of the sort of growth capital trusts that we mentioned, partly on the basis that they're looking very cheap right now. So back to your sort of point, when private investors access these assets, obviously they access them via the listed markets anyway. So they do actually tend to sell out when things go wrong. And so, for example, I think the growth capital sector is down about 12% in the past month. So that means that they don't get so much that effect of maybe stability in the same way as institutional investors do, but it does sometimes create opportunities just in terms of the trusts, the discounts widening a lot and these trusts looking potentially really very cheap. So that is one of the things that we look at in the piece. And then sort of discounts aside, Augmentum and Molten Ventures, quite interesting because they're sort of, they back companies that are quite in the early stage. And Augmentum is in particular is in a play on the fintech sector in the UK, which is an interesting sector because it has been very innovative, very capable of growth over the years. And then the companies do not necessarily list on the stock market or do not do it at the same rate as they used to, perhaps. So it's kind of an interesting way if you want to back, UK companies that have quite strong potential for growth. And then both Augmentum and Molten Ventures have had a decent track record of valuations, of being relatively prudent, although again we're still talking about growth trusts, so it will have an extent of volatility, but they have a decent track record in terms of the business they've sold and how much money they've made. The experts we talked to basically all thought they are kind of at an interesting junction potentially.
I think we too both quite like those. I think we don't cover that many because they are funds, but in the company section, we do cover Molten Ventures. I think we have them on a buy, and Augmentum is a long-standing Simon Thompson pick as well. So some positivity from this end as well. As I say, that is the big read this week. That's available online in the latest issue in the shops, so do take a look. We're going to finish up, though, with a look at Staffline. As I said at the beginning, it's a very small company. It's about 40 million market cap. So some listeners may not have heard of it, but it's a recruitment company. Valeria had its full year results out this week, and they were much better than peers. And there's perhaps one basic reason for that. But can we talk about the results and why that is?
Yeah, of course. So in sharp contrast with peers such as Hayes, Page Group, and Robert Walters, they've sort of seen their revenues and fee income decrease quite significantly in the last couple of years. This is because, after the pandemic, the jobs market boomed, and now it's sort of having a little bit of a calm down. But Staffline actually, as you said at the beginning of the podcast, bucked the trend. So it actually grew revenues, gross profits, operating profits. So revenues were up 14%, gross profit by 10.3%. Although the main growth driver here was its Irish recruitment business, which was up by 38%. But yeah, as you say, the reason is quite simple, and it is that it focuses on the sort of blue collar end of the market. So think, people who work in supermarkets, in factories, involved in food processing and stuff like that. So unlike Hayes, Page Group, etc., they focus much more on the white collar end of the market, which is a little bit more discretionary. But yeah, I would say th- these sorts of sectors have more steady demand for labor. So, if you think about supermarkets, we go there all the time. Manufacturing often runs in just in time labor. Warehouses need staff. Obviously, it also helped that Staffline focuses a lot more on temporary jobs. And obviously, when we see periods of uncertainty, employers usually, gravitates towards more flexibility. So that's also been a focus. Coming back to Hayes, etc. They've been sort of hit pretty hard by political uncertainty. Last year we had so many elections, and obviously things are compounding now with tariffs and higher labor costs, etc. So
which we will come to in a moment. It does seem though for now that Staffline has been gaining some market share as well. Though you mentioned some of those sectors, it's quite a broad spread: supermarkets, logistics, other areas too. But it does seem like it's been making some good inroads there.
yeah, it's growing its market share with Tesco. It supplies pretty much every big supermarket in the UK. Morrison's, it supplies 100% of its temporary workers. But yeah, it also works with really well-known companies in the automotive sector, such as Rolls-Royce, BMW, and some logistics names as well, like DXO.
Mm. Clearly, there's the shadow of tariffs hanging over some of those companies, as there is with most companies at the moment, but also the higher labor costs. Well, what did they say about the kind of things that companies have been up in arms about for the last few months, the increased national insurance costs, things like that? What did Staffline say in these results about how that might or might not affect them?
So management adopted quite a cautious tone in the outlook. Obviously, higher labor costs are a headwind for Staffline. A big chunk of the workers they place are near the minimum wage. So any rise in the national living wage hits their client base pretty directly. It makes hiring more expensive, and obviously that potentially results in companies cutting back on hours, delaying recruitment, or even focusing more on automation, which is obviously not great for Staffline. And then obviously higher national insurance contributions, obviously that pushes up labor costs as well, especially for big employers like supermarkets. So that's definitely a headwind, and it means that it's had a good run, but it's definitely not immune to higher costs and inflation.
Mm. Yeah, it's kept its outlook steady at the moment, but there's a long way to go this year, isn't there? Let's talk about the strategy of the business, because they have recently disposed of the PeoplePlus unit. What does that mean? And what is the sort of overall strategy, in short, for the business? Because it has, as we'll come to in a moment, 5 years ago or so, it had a near-death experience, and management has changed quite a bit. So what are they looking at doing nowadays?
Yeah, so the sale of PeoplePlus, it's a pretty clear sign that they're doubling down on what they would say they do better, which is recruitment. So PeoplePlus is a training and employability business. They relied quite heavily on government contracts, and what the divestment means is that basically the business is much more focused, simpler, and obviously less exposed to political cycles, especially last year when we had the UK election, and that sort of meant that contract wins dried up quite significantly. And it also means that they've now shed a lower margin, much more capital intensive part of the group, which is obviously going to help improve returns and free up cash over time. But the overarching strategy is just basically to keep focusing on sectors where there's essential sectors that have steady demand for staff, and continue to grow market share and temporary and permanent recruitment. And then obviously tighten up margins, which was sort of one of the reasons for the divestment.
Mm. As you mentioned, shares have been on a good run this year. Certainly since the start of the year, there's a big leap in February. If we go back to that period, it was pre-pandemic actually, when I think shares fell by about 95% in a year. The company was clearly at death's door for a while. Things have changed, as you would expect, pretty soon after that, they rang some changes, and most of the management team has been in place since around that time, or certainly some of them. So it's probably fair to say they are better managed now than they were then.
Yeah, it's definitely fair to say they're better managed now. In 2019, 2020, that was a really rough period for the company. There was a mix of things. There was an accounting scandal, mounting debt, and some pretty serious governance issues that almost took the company under. And unsurprisingly, we had sort of the whole senior leadership team sort of replaced. But I think it's fair to say as well that the new management has done a solid job stabilizing the business in the last couple of years. They've cleaned up the balance sheet, so that means that the company's now net cash positive. Again, with the sale of PeoplePlus, exiting non-core areas, and as I said earlier, just doubling down on what they do best. So yeah, the transformation has been pretty impressive.
Well, as we said, this is a very small share, so it could be volatile, but then what isn't at the moment? It's certainly done well over the last few weeks, and an interesting company to look at. That, though, does bring us to the end of today's show. So thank you very much to Valeria, to Val, to Mark, to Julian, and to our producer, Maddie Apthorpe, and to you for listening. We'll see you next time on another Companies and Markets show.